Hey everyone, and welcome to Momentum channel. In this video, we wanted to talk to you about the stock market, what it is, and how to start investing your money into stocks, how to diversify and take advantage of low-cost exchange-traded funds to achieve financial freedom. The contents for this video have been selected based on a summary of Wealthsimple Investing Masterclass, which consists of a series of educational videos lasting about an hour. If you have time, I encourage you to check out the entire masterclass through the link provided in the description down below. But for those of you who are looking for a crash course in investing under 25 minutes, this video would be perfect.
Welcome to the Wealthsimple Masterclass. Come on, Nick. You're about to become an investing genius. Now, if you're watching this, you're at least a little curious about the stock market. Maybe that's because you want to have more money for your retirement or a dream home. And maybe you still want to leave those kids a grand inheritance. Or maybe you realize that saying, I'm buying weed stocks, every time your friends bring up investing is starting to grow old. Now, the stock market is a place where companies like Apple sell tiny pieces of themselves to raise money for all sorts of things. Inventing new products, building new factories, expanding to new countries, or hiring more people. And anyone, you, me, can buy those pieces. So when a company in the stock market makes money, everyone who owns a piece of that company profits too. Basically, the price or value of each stock is determined by the buyers and sellers in the market, meaning the last price that someone was willing to sell it or buy it for. And if good news happens, like a drug company gets a cool new drug approved that reverses hair loss, stock price should go up. If bad news happens, like the company's CEO and founder gets arrested for embezzlement, the price of the stock will likely go down. Obviously, it has its ups and its downs. But if you look at its progress over the last 130 years, you'll see the stock market has pretty much always grown up and to the right, which has resulted in more cool technology, more new jobs, more life-saving medicine, and, more of all the important stuff. All told, we like to think of the stock market as a reflection of human progress, which means if you think humans will keep inventing, keep making, keep selling, and keep buying things, then the stock market might be a good thing for you to invest in. Let's start off by helping you avoid maybe the most common and important mistake. A lot of people think investing is about picking stocks. Hey, this is going to be the next Amazon. Yo, my rich uncle says this is the next hot stock. We should buy it too. Yeah, a lot of people invest that way. It's called active investing. But stock picking is not something for the faint of heart or the inexperienced. Actually, experience is no guarantee of success either. In fact, there's a whole industry out there that charges people tons of money to pick stocks for them. And if you think that's the best way to win at investing, there's a monkey we want you to meet. In 1973, the Princeton University professor of economics, Burton Malkiel, claimed that a blindfolded monkey throwing darts at a list of stock symbols could rival the careful selections of experts. Historically, dart-throwing monkeys haven't just rivaled the experts, they've actually done much better. But don't let the fact that a monkey could do it better discourage you. Research shows that passive investing, the practice of investing in big chunks of the stock market and holding, beats the active traders who pick individual stocks 84% of the time. Did you get that? Pretty much all of the time. It's a bad idea to pick stocks yourself or pay someone to do it for you. Over the past 130 years, the markets have continued to rise despite depressions, world wars, tech bubbles, and real estate crashes. Guess what strategy most investors would have been best off sticking with? You guessed it, the boring old passive strategy of buy and hold, which means you buy stocks and hold them for the long term, regardless of the ups and downs of the stock market. It's best to think long term and not dance in and out by trying to predict stock winners. What if you actually have a tidy little sum in your savings account? Should you keep it there or take it out and invest it? But that's risky, right? Well, it depends on your timeline. If you're gonna need your money soon, let's say for buying a house in the next year or two or your emergency fund, then yes, stash that cash in a good savings account. But if you're thinking long-term about retirement, your kid's university, or buying a home further down the road, 10, 20, or 30 years from now, then definitely invest and enjoy the growth of the stock market. Even if you put a high percentage of your income into a savings account, it probably won't be enough for retirement. Unless you're billionaire Richard Branson or something, in which case, hello, Richard Branson, thanks for stopping by. Not great. But for the rest of us, investing some of our income is key. That's because the best savings accounts only earn around 2% interest, whereas the stock market, on average, has earned about 5% over savings accounts per year. You'll never get those kinds of returns stranding your money at the bank. Start with a small percentage of your income and gradually increase the percentage over time. Even if you begin with just 1% of your income and grow it over time, you will end up in a much better place than doing nothing at all. The 5 simple rules. Start investing early, today, right now, even if it's just $1. There will never be a better time. Here's why. Compound interest. Imagine we have 2 brothers, one's 30 and one's 40 years old. They each start putting away $5,000 a year until the time they retire at 65. So at retirement age, the 30-year-old has invested $175,000 and the 40-year-old $125,000. So $50,000 difference. It's a good amount, but it's nothing crazy. Now, how much does that $50K difference turn into over time due to compound interest? Close to $500,000. That's a life-changing amount of wealth to lose out on for only missing 10 years of investing. Think about it. That's the kind of money you leave on the table if you don't start investing early. But if you're like the older brother who didn't start investing early, don't panic. Remember to just control what you can and start today. You remember that story we told you about the monkey who outperformed all those professional stock pickers? Recently, the same experiment was run, only this time they swapped out the monkey for a lovable cat named Orlando, and the newspaper was The Guardian. An animal, not a human being, randomly picking stocks, and over the course of a year, Orlando's stocks had a better return than ones picked by top stock pickers at top investment firms. The moral is, don't bet your retirement on picking stocks. Don't pay an expert to pick stocks for you. Instead, invest across the stock market as a whole. So how do you invest in the entire stock market? Buy one of every single stock? Luckily, there's a much easier, cheaper, and more effective way. Index funds, also known as ETFs. And these are exchange-traded funds, and they track the entire stock market for you at extremely low prices. Which brings us to our next rule. Wake up! Usually in life, the more you pay for something, your house, your car, your clothes, your vacation, the better it is. The opposite is true when it comes to investing. Paying a financial advisor 2% a year in fees may not seem like much now, but over the course of a lifetime, it could add up to hundreds of thousands of dollars. It's kind of like the compound interest we talked about before, but here it works against you, meaning all those fees can really snowball out of control. Let's look at 2 people who invest $1,000 a month for 30 years. The first pays 1.5% in fees, the next pays just 0.5%. A 1% difference might not sound like a lot, but it could translate to costing you around $300,000. Congratulations, you just bought your expensive advisor a Ferrari. Investing in stocks and bonds comes with risk, which is partly why it can be really lucrative. You've probably heard that it's good to have a diversified portfolio. That's really just another way of saying don't put all your eggs in one basket. I mean, what would have happened if you'd invested 100% of your money in Blockbuster? RIP. Smart investors find ways to manage the risk. One important tool they use is diversification. If you spread your investments or eggs across lots of different industries, green energy, pharmaceuticals, industrial tech, in lots of different countries, you can protect yourself against the ups and downs of any one part of your portfolio. Here's a good way to think of it. This chart shows 6 different common indexes: US stocks, emerging markets, Canadian stocks, bonds, real estate, and international stocks, and how they performed each year. Foreign stocks might not perform as well as emerging market stocks one year, or they might outperform them the next year. But when you invest in a wide range of indexes or diversify your portfolio, you help protect yourself against the year-to-year rises and falls. Remember, a smart investor focuses on what they can control. Here, that means to diversify and stick to their long-term plan. That brings us to the final rule. Emotion is the enemy of smart investing. And when the market's up and down, it's easy to get emotional. The market's up, I made $72. The market's down, where's my damn $72? The world is ending. Sell everything, hide the clam dip. Why am I eating clam dip? I'm gonna get sick. But history has shown that trying to time the market usually leads to worse returns. Don't listen to the entertainers on CNBC who yell, buy or sell. Have the conviction to stick to your plan in both the best and worst of times. Investors who chase performance or run away from losses are doomed. The thing that differentiates good investors from bad investors is simply the discipline to drown out the noise and stick it out for the long run. Now, you might be saying the 2008 recession is hardly noise. You're right. It had a huge impact on a lot of people's life savings and affected the economy for years. But the people who panicked when the market hit bottom in 2008 and pulled out their retirement accounts to cut their losses missed out on the next 10 years, which has produced some of the greatest returns in the history of the stock market. Point is, you can never know when a recession might hit. But smart investors stick to their plans and think long-term no matter what. And after learning these 5 simple rules, that's what you are, a smart investor. After learning some of the basics, we know you're ready to start investing and see those returns, which is exactly how you should be thinking at this point. But first, you need a financial fitness check. We like to think of it as a super classy champagne waterfall. It's your money that's flowing. And if you set up the glasses in the right way, it will set you on the path to being extremely smart and financially sound. If you have debts with an interest rate above 5%, like on a credit card, you absolutely must pay those off before you do anything else. Because you'll be paying more in interest than you'd make on pretty much any investment, you'll be losing money by not paying down your debt. We should all be ready in case something unexpected happens. An illness, a layoff, a terrible decision to buy the world's most expensive dinosaur bones from Nicolas Cage. Otherwise, you're gonna have to go into debt to support yourself before you're back on your feet, and then you'll have to start the waterfall all over again. So it's smart to set aside 3 to 6 months of expenses. Think of this as a safety net for your financial future. Congratulations! You're now high interest, debt-free, and you have your emergency fund. Now let's get you some free money. Because that's what an employer match is. If your company gives you extra money when you contribute to your retirement account, called matching, and you're not taking advantage, you're essentially turning down part of your salary. Don't do that. Get that money. The government. They want us to save for retirement because then, when we get old, we won't become expensive problems for them and society. And the big incentive they offer to do that is these tax-advantaged retirement accounts. Money in these accounts, sometimes called a TFSA, a tax-free savings account, or RRSP, they all grow tax-free. Now the champagne's really flowing. You got 4 glasses full. There's no more high interest debt holding you back. You and your family are secured with an emergency fund in place. Free money from your boss is coming in. Tax-free accounts are up and running. The next best thing to do with extra cash may be to pay down other debts, even those with an interest rate of less than 5%, like mortgages, student loans, car loans. Why? Well, these low interest debts still have some interest, which means they could be eating into any financial gains you make through saving and investing. Now let us pop some bottles, because if you've made it to glass 6, you definitely deserve a toast. Seriously, making the most of employer and government retirement programs and paying off all your debt, it's a huge achievement to celebrate. But even better than a chorus of Mazel Tovs, it's that it's time to make some decisions. So one option you have is to invest in a personal account, an investment account that gets taxed. You could also choose to max out your retirement accounts. Another option is to consider putting money toward larger savings goals, whether it be a new car, house, or graduate school for your 9 children. Remember, if you have money that you intend to spend on a big purchase, house, wedding, college, within the next few years, it should go in a savings account. Any investment folks who guarantee you gains in the short term are people to be suspicious of. But you know that. After 6 full glasses of financial health, you're expert level now. Chin chin. Let's pretend you have a good side of your brain and a bad side of your brain that are making financial decisions for you. The old angel and devil on your shoulder. Now imagine a robot comes along and puts the devil in a headlock so he can't influence you anymore. This heroic robot is what we call automation. Chances are your paycheck is directly deposited into your checking account. If it's not, and your company offers that option, you should go ahead and do that before you do anything else. But you don't want your whole paycheck going directly into your checking account. Set it up so that a percentage goes into your company retirement account first. Now, as soon as your paycheck electronically hits your checking account, there are 2 accounts you want it to automatically fund: your savings account and your investing account. You can do this using your checking account to make automatic recurring transfers into each one. This will make sure the right amount comes out of your checking account and into your savings and investing accounts like clockwork before you even have the chance to spend it on that fancy pair of new shoes. Make your credit card the default payment method for bills that you know will be the same amount every month: gym, insurance, mobile phone, etc. After your paycheck has been directly deposited, your savings and investing accounts have been funded through automatic transfers, and your credit card balance is back to 0, there's another tool to use: bill pay. You want to use this checking account feature for bills that require a check. Your rent, for example. Each month, your bank will automatically cut a check and mail it to your landlord. Then the only thing left for you to do is read the email alert your bank will send. But what happens when you have a little more money than usual? First of all, nice work. Maybe you got a bonus, birthday gift, or just spend a little bit less. It's important to put that money to work for you and not spend it on extra margaritas. Look at you. You're really doing it. You're investing. And you're smart about it because you know what you're doing. You're harnessing the unparalleled engine of financial growth that is the stock market. You know how to do it. Automated, diversified, long-term investing. And you know when to do it right now. First, there are 2 things you need to consider when deciding who to trust to help you invest, or if you need anyone at all. 1, what you're paying for, and 2, how much you're paying for it. Whether you go with us or someone else, make sure you know what you're paying in fees. Now, while we can't speak for everyone, we can tell you that Wealthsimple charges a fee that we're 100% transparent about. It's 0.5%. And that goes down to 0.4% for clients who invest $100,000 or more with us. Statistically, those are very small fees for the services we offer. But more importantly, let's look at what that fee gets you. The first thing you get when we invest your money is a very efficient, very sophisticated portfolio, personalized for your needs. How old you are, what you're saving for, when you'll need money, and how comfortable you are with risk. We spend a great deal of time and energy building next-generation portfolios that are diversified. You might be saying, couldn't I just buy a bunch of ETFs and do it myself for less? Sure, you absolutely could. You just have to calculate the right mix of funds for your risk appetite and then buy that balance at regular intervals without letting emotion get involved. When we design a custom portfolio for you, we put your money into many different kinds of investments, and we'll adjust your risk level based on your goals. That's called your asset allocation. But markets never stand still. And as they go up and down, your asset allocation can get all out of whack. So we constantly rebalance your assets for you. We also do something called dividend reinvestment. Now, sometimes the companies in your portfolio give a little kickback to the share owners. This is called a dividend. And rather than blowing your dividends on lottery tickets, we put your dividends right back to work for you so they can earn even more money without you having to make a decision or lift that little finger. We also want to make your account as tax efficient as possible. When the value of an investment goes down, you're allowed to deduct the losses from your taxes. Wealthsimple uses a feature called tax loss harvesting to automatically save you a ton on taxes. If you want advice on how much to invest or how much risk to take on, that small fee gets you free, unbiased advice from our expert team of portfolio managers. But I guess, if you love Microsoft Excel spreadsheets and tax law and still want to do all the work of maintaining a portfolio, you can. Socially responsible investing has grown tenfold over the past 20 years. And there's now $22 trillion in SRI assets worldwide, with good reason. Research shows that SRI portfolios have strong performance compared with regular portfolios. Wealthsimple can build you a custom SRI portfolio in a matter of minutes. You'll be invested in clean tech companies with low carbon exposure, companies with better gender diversity, companies that help promote affordable housing, so that you get a perfectly balanced portfolio that works for your risk level, whether it's conservative, balanced, or growth, as well as your beliefs. Are these cacti making anyone else a little uncomfortable? We make choosing socially responsible investing as simple as turning on a light switch or off. Focus on long-term, steady growth with a balanced portfolio made up of ETFs that track the market as a whole. And never gamble with more than 2 to 3% of your entire portfolio in these little individual stocks, bonds, currencies, or commodities that you have a good feeling about. We don't completely lack an adventurous spirit. That's why we created Wealthsimple Trade. Wealthsimple Trade isn't just low cost, it's actually commission free. What's more, you can do it all from a beautifully designed mobile app. There's no account minimums and your money is SIPC protected up to $1 million. But again, we don't think stock picking through us or anyone else is the way to build a retirement for future you. Still, there's honestly nothing wrong with wanting to invest in companies that you believe in. Think of it as an extra little champagne glass at the very end of your financial health waterfall, not your nest egg. So we're going to give you some conventional wisdom on what it looks like to be financially on track for retirement at any age. What we don't want you to do is freak out if you aren't there yet. Because if we're being really honest, most people aren't on track. And even the ones who are have gotten knocked off the track once or twice by this little thing we call life. Take a look at this chart. By age 35, you should have twice your annual salary saved. By age 40, you should have 3 times your annual salary saved. By age 65, you should have 8 times your annual salary saved. There's a formula behind it. It assumes you want to retire at 65 and that you'll need a nest egg to live on for the next 20 or 30 years after you stop working. So these numbers reflect both something you'll want and something we believe you can achieve. Wealthsimple. We help make wealth easy. Or